Well, having Laurence Black with me today from the Index Standard is the founder, and again through a process of understanding the dynamic of new wisdom of Wall Street, and they have some really great information at their firm to share with us. And I thought it might be really helpful for Laurence to go through a couple points with us, as the Index Standard is a NAFA Premier Partner, and we really appreciate that. And one of the things that I love to accomplish with folks like Laurence is that developing ways to obviously serve our end consumer and really educate them, and as well as agents, as well as IMOs, and really kind of an opportunity to do that. So really appreciate you being here, Laurence.
Great. It's really great to be here with you, Chuck, today.
So why don't you tell me a little bit about the Index Standard first, so people can kind of go through a process and understand the dynamic of what you guys are doing.
Sure. So firstly, we love being a partner with you. You're obviously the key industry body, and for us, that's very important to be associated with you. And what we do at the Index Standard, you can think about us like Morningstar, except we're focused on the complex space. So we're focused on the insurance and structured product space. Now, what we do is we rate and evaluate indices and ETFs. We kind of give them platinum, gold, or silver. We also have 10-year forecasts, which we're going to talk about today. And then we have what we call our model allocations. And we do this for IUL and fixed index annuities. And you can think about the model allocations as an all-in-one cheat sheet that everything you need to know about an FAA we provide you. And really our goal at the Index Standard is to really help people understand what they're selling and make that process more efficient and easier.
And obviously you have some great intellectual horsepower at the Index Standard, really based on significant academics. Tell me what you should even think about with forecasting.
Yeah, so I think with forecasting, the first thing is I sort of liken it to a couple everyday examples. So let me give you the first example, right? If you're driving your car, do you drive your car just by looking in the rearview mirror? No. Well, most of us will do both. You'll look forward and you'll look backward. So let me ask you this, like why, when we're making the most important financial decisions of our lives, are we looking backward almost exclusively, right? That's a key thing. This is much more important in a way than driving, right? This is your financial health, how you're going to retire. So you kind of want to look forward and backward is the way I think about it.
No, that makes a lot of sense. And I think, kind of some of the basis that we get from a standpoint of, our biases and stuff really kind of come to play. And I think this is where you guys can be really helpful to understand the dynamic, to get rid of that and really look forward so we can really make a really informed decisions. What are some of the things that you look at when you're forecasting?
Yeah. So let me just make one other point before I get into that. The other thing is, I think sometimes illustrations can be a little bit misleading. So let me give you another example. Let's take the NASDAQ and Apple, two obviously very well-known companies and indices. So the NASDAQ right now, the last 10 years have been amazing. It's actually annualized at about 17%. So, and Apple is the biggest constituent of that. So when you see 17, most people say, okay, if I believe that, that means, I'm going to compound 17 over the next 10 years. So let's take Apple and compound it at 17%. So Apple, the market cap is about $3.5 trillion right now. So if I compound that at 17% a year for 10 years, that means Apple's market cap will be over $15 trillion. Like for some context, the US GDP is about 27. So if that illustration is going to come true and Apple's going to grow at that pace, that would mean we'd all have to be wearing Apple watches, driving Apple cars, and living in Apple houses or something like that. So, and even if you say, well, let's compound at 10%, that's Apple, that'd be about 9 trillion. That's still a third of the US GDP. So sometimes these illustrations can be a little bit misleading when you just apply some common sense logic to it, Chuck.
Yeah, and I think the context is so important there and understanding that dynamic because of that, right? Like, as we have this amazing growth over the last bunch of years, and obviously there's a big paradigm shift too. So does that sustain? So, and again, thinking about those over the course of time, to your point, that we'd be in a totally different world in a sense.
No,
So
that's a
again,
great point. And I just wanted to come back to your other question, which is, how do we think about forecasting? So the first thing I want to kind of mention about forecasting is that it's actually been done for hundreds of years. It's not anything new. And it sort of really began with Charles Dow in the late 1880s. He had his Dow theory, where he looked at 6 factors and tried to forecast what was the sort of precursor to the S&P. And then you had Benjamin Graham, who's sort of known as the father in value investing. He would try forecast the S&P by looking at earnings and then apply a multiple. And then, more recently, you had Robert Shiller doing it. You had research affiliates who have some good research on fixed income, and even Jack Bogle at Vanguard, very well known. He would try and forecast the S&P, and he would use dividends and price earning ratios to kind of try and extrapolate some numbers. So, we've seen forecasting being done for hundreds of years. And today there's actually a forecasting association. So there's more than 70 members, and a lot of asset managers and big banks will actually produce these forecasts. Now, they produce forecasts anywhere from 5 to about 20 years. Now, what we find at the Index Standard is we find that there's a lot of forecasts at the 10-year point. So that's something that we actually like to use, because there's over 35 asset managers who forecast, various asset classes at the 10-year point. And what we do is we simply, every quarter, we go to all these forecasts, we average them out, and then we have what we call the wisdom of Wall Street that'll help us think about what is the average forecast for the next 10 years for key asset classes like stocks, bonds.
so that's really great stuff, Laurence. Now tell me what you're seeing with the latest forecast you're doing.
Sure, Chuck, and actually let me just bring up some slides, as I think that probably makes sense just to visually show you. So what we're seeing, the average of these 35 asset managers is now on screen that hopefully you can see. And what I'm showing you is really the equities total returns. So you can see in yellow on the left, that's the S&P forecast total return. It's about 6.6. Now, we all know and love the S&P, but we tend to forget, other regions. And, if you look in green, that's emerging markets. And you can see you can get some pretty solid returns from what Wall Street expects, about 8.2. And likewise, EFA, you can get about maybe 7.8. But let me give you a little bit more color here, because, the numbers are what they are, but let's think about valuations firstly. So if you think about the S&P, it's actually pretty highly priced right now. And this is because we've had this fantastic run with the AI narrative. And the S&P over the last 10 years has done up almost 14%. Like 13.7 to be precise as we record this. So, Wall Street is expecting those returns to come down. But then again, let's look at emerging markets. Over the last 10 years, emerging markets have just done less than 2, right? So that's why it's much higher, because Wall Street has seen that it's very low. They expect those returns to come back up to the average. And secondly, valuations in emerging markets and EFA are very low. And then again, you look at EFA, the last couple of years, that's down around about 5.5. And, everyone sort of seems to think that Europe is a very low growth area. But if, President Trump is able to drive some peace in Europe, maybe there will be a spurt of growth with rebuilding. And, maybe the returns could be as high as 7.8, according to Wall Street. So, as I look at those numbers, I think the key thing is to sort of really think about being diversified. There's a very famous economist called Daniel Kahneman. What he said is, we all have recency bias. We see the things that we remember, the things that happened most recently. And in terms of finance, we're all remembering the amazing S&P returns. But I think it does pay to be a little bit diversified across different regions, because some of them are pretty cheap right now, and you may get some solid returns. And then I just wanted to make one further point, is that I'm talking about the total return numbers here. Now I'm going to show you the price return numbers for the S&P. So in S&P, in a lot of insurance products, what we see, it's a price return, and we see about 4.8. So that's the kind of number that Wall Street is expecting when that's the product that's being used in a lot of, beg your pardon, that's the index that's being used in a lot of products, and the return is about 4.8.
Now that's a really good point to bring out, because a lot of our products have an S&P index in them, and to understand the expectations of clients, to say, okay, this is what the expectation is, but you got to understand what the difference is in the S&P price return versus the index with dividends. I think that's really great information. I think it is important to kind of go through the process and what you think about these other asset classes.
So let's have a look at those other asset classes. And on screen, we're showing some of the expectations for bonds and commodities. So let's focus on the left. Those are the expected 10-year returns for US aggregate bonds and global bonds. And that's a pretty respectable around about 4%, which is pretty solid. So I think that bonds could, help in those indices and in the portfolio. And then, to the right, I think it's kind of interesting, the commodity forecast. And those may be where I want to spend a little bit of time, because first of all, general commodities are forecast to be 6.3. So that's relatively high. And in general, commodities over the last couple of years have averaged about 1.3%. So the returns have been pretty low. So I think Wall Street there is really expecting that, because the returns have been low, they're expecting them to sort of come back to the average. And we've seen some of the prices of commodities have been low, but we're now starting to hear talk about inflation, so maybe some of them go up. Now gold is actually the kind of converse, because gold has done very well recently, as it's almost hit 3,000, as I'm sure many of the listeners know. And gold in the last 10 years has done almost 8%. So that's a pretty solid return. So I think what Wall Street is expecting is that gold returns may be sort of muted at about 1.5. So, it's kind of interesting how each asset class has its time to shine, and then other times when it's done well in the past, Wall Street expects it to come down. So I think, again, kind of this points to being a little bit diversified, sprinkling a little mix of different asset classes in your portfolio.
And I think, if nothing else, I think what this does is, when you're talking to clients and understanding clients, is at least exposing them to all this information becomes important, so that they understand the dynamic of all the different asset classes that you might work with, and have some type of percentage in their overall plan as they go forward, to really make it work. So really appreciate that.
Yeah, perfect. Couldn't agree more, Chuck.
So I know you've been doing this for a long time. How is your forecasting doing? How are you actually going through this process and understanding this over the course of time?
Yeah, that's actually the right question and the right way to think about it. And at the Index Standard, we've been going for about 4 years, so we're thinking about that too. So what we've done, Chuck, is we've kind of want to benchmark how we're doing. So what we've done, we went back to some of our first forecasts in November 2020, and we measured them. We kind of do it every May, because it's exactly 3.5 years. We kind of want to do round numbers. And what we are showing on screen is, in gray, is our actual forecast that we did in November 2020. And then we show in blue the actual returns as of May 24. So what you can see is, I'm going to work through each asset class and index. I'm going to start from the left. So you can see the S&P. So we forecast round about 6. And you can see, as of that point, the S&P had done about 11 in actual. So we were a little off there, and the wisdom of Wall Street, has been surprised by the AI narrative and the strength of it. And then secondly, if we look at the Russell, we were forecasting again around about 6, kind of respectable, done 3.5, 4. Same with EFA, the forecast was just at 5, coming in at about 3.5. Dow Jones, as you can see, that second from the right, that was pretty spot on. And then bonds, what we saw is, from the wisdom of Wall Street, we did see a relatively low forecast, kind of round about 2. But what we know is, what happened is, as the Fed raised interest rates, bond prices came down, and you see that bonds actually had a negative return. So overall, we were pretty pleased that we were not too far off. We missed the S&P, but overall it seems pretty accurate. But I think the real question you should also be asking is the following: what did the historical numbers say at the same time? So if you believe that the historical numbers were the right ones to look at, how would that compare? So now what I'm going to do is bring up a slide with the historical numbers as of 2020, and that by historical I mean you were looking back from November 2020 to November 2010, and those are the numbers in purple, and you can see they were all pretty high. So look at the S&P. It was about 13, came in at about 11, so that was okay. But then the rest of the asset classes, it's been a little bit misleading, because you can see for the Russell, it was around about 11, came in at 3. EFA was about 12, came in at about 4. Dow Jones, again, 13, came in just over 7. And then again, even with bonds, you were seeing a sort of round about a 4 number, but it came in at a negative. So this slide makes us quite proud, because we think it actually illustrates the value that looking forward can have. I don't think either is going to be right, but certainly looking at both of them makes sense.
No, and I think giving clients that opportunity to understand that dynamic is so important, because it ultimately what your slide is showing me is that the power of diversification is incredibly important to understand that as you go forward. And then also, like, the variables that come in, because I think particularly on the S&P, where the last couple of years been driven by the Magnificent Seven, and kind of like and understanding that dynamic, how different it is than some of the other areas. And I don't think clients, to your point, with recency bias and what they're thinking about, might not get that.
Yeah, that's a great point, Chuck. And I think for me, one of the key things that I've kind of learned is that you really want to be diversified, because it's very hard to predict which asset class is going to do well. So I think looking forward, looking a little bit back, gives you the sense of where you should be. And I think being diversified, especially going forward, really makes sense, because we've seen such strong returns from US benchmarks that maybe some of the other regions might come up and do pretty well as in the future as well.
So any last thoughts, Laurence?
Yeah, I think I like what one of our clients said, and he said the following. He said, listen, I don't think you can look at back tests in isolation. I don't think you can look at forecasts in isolation. He said, I think you need to look at both of them together. And usually the truth will somewhere be in between. And for me, that's a really great thing, because you want to, just like you're driving your car, you want to look forward and you want to look through your rearview mirror.
Now that's outstanding. And one of the things you guys do publish is this Wisdom on Wall Street, which we will make available to folks that are watching this and going through this process. So really appreciate that. And I know you do that a couple times a year. So we look forward to continuing our dialogue throughout the year.
Indeed. And we appreciate your support, Chuck.
Thanks so much, Laurence.
Thank you.